How exactly does a company secure a $9.7 billion artificial intelligence infrastructure deal with Microsoft, yet still get priced by the market like a cyclical boomer-bust cryptocurrency miner? We're looking at Iris Energy, known by its ticker IREN, and right now they represent one of the most fascinating valuation disconnects in the entire market. This is a company caught right in the middle of a massive structural transformation. They're aggressively ripping out their legacy Bitcoin mining hardware to power up high-density liquid-cooled data centers for global tech hyperscalers. But the market seems entirely fixated on the painful, cash-burning reality of that transition phase, completely ignoring the long-term high-margin cash flows that are already contractually secured. So today we're going to break down exactly what is happening inside IREN, the incredible vertical moat they've built, the very real dilution risks terrifying the bears, and what investors need to watch as this pivot unfolds.
To truly understand the scale of what's happening here, you have to absorb one staggering number: $9.7 billion. That is the value of the massive 5-year GPU services contract IREN recently signed with Microsoft. This isn't some speculative pilot program. This is a foundational anchor tenant validating a total transformation of IREN's core business. Microsoft is actually prepaying 20% per tranche to help fund the $5.8 billion in GPU capital expenditure required to deliver 200 megawatts of critical IT load. And they aren't the only ones doing this. IREN also secured a $3.4 billion agreement with NVIDIA to deploy Blackwell architectures. These contracts fundamentally alter the company's DNA. It proves that institutional tech giants actually trust IREN's infrastructure to handle their most intensive large language model training.
And this perfectly illustrates the core shift happening under the hood. We are looking at a radical pivot from their old economic engine to a completely new one. Historically, IREN depended on spot liquidated Bitcoin mining. That meant their profitability was entirely at the mercy of global hash rate growth, network difficulty adjustments, and halving cycles. It's a roller coaster of volatility. Now, look at the new engine: fixed-rate AI cloud services. By converting their massive power assets to host GPU cloud workloads, they are shifting from unpredictable commodity pricing to highly predictable, multi-year annualized recurring revenue. They're essentially mutating into a specialized, institutional-grade neocloud provider.
But you might be wondering, how are they beating out the established competition for these massive hyperscale contracts? Well, it comes down to a really deep vertical infrastructure moat. Unlike legacy cloud developers or traditional data center REITs that lease space and get bogged down in multi-year utility queues, IREN owns the entire stack. They own the land outright, they own the high-voltage substations, and crucially, they have direct 345 kilovolt transmission-level grid connections. By completely bypassing lower-voltage distribution networks and third-party landlord markups, they secure wholesale power at an incredibly cheap 3.1 to 3.5 cents per kilowatt-hour. While competitors like CoreWeave or Nebius have historically dealt with expensive leases, and crypto peers like Marathon Digital have struggled with vertical integration, IREN's ownership model gives them an adjusted EBITDA margin structure of around 41%. That makes them highly competitive in both speed to market and outright cost.
And by the way, if you like deep, evidence-based stock breakdowns like this, make sure you're subscribed. Because what IREN is actually selling on top of that cheap power is highly specialized. We're talking about access to bare metal GPU instances, which is essentially raw, unfiltered computing power and managed cloud orchestration. They deploy high-density NVIDIA GP3000 liquid-cooled superclusters. And to make this ecosystem even stickier for customers, IREN recently acquired a cloud software provider called Mirantis. This allows them to offer workload orchestration right on top of the hardware. So when an enterprise client configures their proprietary AI model training on IREN's managed platform, they face massive operational friction and retraining costs if they ever try to pack up and leave. That creates a powerful, almost monopolistic lock-in effect.
But here is the central conflict the market is struggling with right now. When IREN announced their Q3 fiscal year 26 earnings on May 7, 2026, total revenue was completely flat at $144.8 million. It actually declined sequentially. Why? Well, they had to aggressively turn off their own Bitcoin mining hardware, which drove mining revenue down 33.6% just to free up the physical power capacity to build out these high-density AI cloud centers. Now, the AI cloud revenue did surge 94.2% sequentially to $33.6 million, but it simply wasn't enough to cover the massive revenue hole left by the decommissioned mining rigs. The market saw this revenue miss, which came in 34% below analyst expectations, and completely panicked.
That transition was incredibly painful on the bottom line. IREN posted a staggering $247.8 million GAAP net loss for the quarter. That missed analyst estimates by over 36%. Now, to be fair to the underlying business here, this loss was heavily driven by non-cash charges. Specifically, they took a massive $140.4 million impairment charge simply because they were retiring and writing off that old legacy Bitcoin mining equipment. It's the literal cost of the pivot. But $250 million loss in a single 3-month period is exactly why the market is treating this stock with such extreme caution.
Because what really terrifies the bears isn't just that GAAP loss, it's the massive 47.8% shareholder dilution over the past year alone. To actually fund this transition and to buy billions of dollars worth of NVIDIA GPUs, management has had to aggressively issue equity and debt. As of the end of March 2026, IREN was carrying $3.69 billion in convertible senior notes, and they have an active $6.0 billion at-the-market equity issuance program. This means that while the company is growing its physical asset footprint massively, the slice of the pie owned by an individual shareholder is shrinking rapidly. This is the ultimate tension: hypergrowth infrastructure funded by hyper-dilution.
If we pull all this research into a qualitative scorecard, you can see these opposing forces colliding in real time. Overall, the business scores a blended 7 out of 10. The growth outlook is a brilliant 9 out of 10, backed by a 5-gigawatt global pipeline and contractually secured hyperscale demand. Revenue quality is a really strong 8 out of 10, as they shift from volatile crypto spot prices to multi-year prepayment-backed contracts. But that clashes hard with a 5 out of 10 in profitability due to those heavy GAAP losses we just talked about, and a very concerning 6 out of 10 in capital allocation. That lower score reflects not just the massive shareholder dilution, but also significant insider compensation, including a recent $570 million stock package approved for the co-founding Roberts brothers, alongside some heavy insider selling.
Now, all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports exactly like this one for literally any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free, but if you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every single week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters.
They also have Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code pop up on the bottom right of your screen. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
All right, let's move on and see how this all builds into our 5-year scenario analysis to map out exactly where IREN's valuation could go. But before we dive into the numbers, please remember, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios.
To justify a long-term re-rating and finally escape that Bitcoin miner valuation penalty, IREN has to execute flawlessly on this physical runway. They are currently targeting 480 megawatts of operational AI cloud capacity by the end of 2026. Then, they need to more than double that to 1.2 gigawatts in 2027. And the ultimate goal for this 5-year horizon is to scale their global footprint up to 2.5 gigawatts by fiscal year 2031. Every valuation model for this company depends on them hitting these physical construction and grid energization milestones absolutely on time.
In our base case, which carries a 55% probability, IREN successfully phases out its legacy mining fleet by 2027 and scales to that 2.5 gigawatt target. Monetizing those anchor contracts with Microsoft and NVIDIA pushes total revenue to $6.5 billion by year 5, which is an incredible 45% compound annual growth rate. Assuming hardware depreciation and energy costs settle them at a 22% net income margin, they generate over $1.4 billion in net earnings. Even accounting for expected share dilution, pushing the float up to 472 million shares, applying a standard 18x infrastructure PE multiple gives us an implied share price of $54.53. From their current price, that represents an annualized return of roughly 4.3%. It's steady, infrastructure-style growth.
But the extremes are where this gets absolutely fascinating. The 25% probability high case models a scenario where AI compute demand stays red hot. They scale to 4.0 gigawatts globally, expanding heavily into Europe and Australia. Their high-margin Mirantis software layer pushes net income margins to 26%, driving revenue to $10 billion. Crucially, in this scenario, NVIDIA exercises its strategic warrants at $70 a share, bringing in massive non-dilutive capital. At a 22x premium cloud multiple, the stock rockets to $127.11, an annualized return of over 23%. Conversely, the 20% low case models a brutal reality check. AI capex slows down, Meta dumps excess compute on the open market, crashing rental rates. Revenue peaks and compresses to $2 billion, margins collapse to 12%, and IREN is forced to aggressively tap its ATM equity program just to service its convertible debt, pushing outstanding shares to 550 million. At a penalized 12x multiple, the stock plunges to just $5.24.
To avoid that low case, we have to acknowledge the very real risks that could break this thesis. First, scaling direct-to-chip liquid cooling at their massive Childress campus is complex engineering. It's not just plugging in more fans. Any delays there could trigger strict financial penalties for Microsoft. Second, extreme customer concentration. Microsoft is their anchor tenant. If Microsoft sneezes, IREN catches a severe cold. Third, regulatory grid constraints. The ERCOT Texas grid is under heavy scrutiny for transmission capacity. Any unexpected state-level interconnection delays would completely freeze their monetization timeline. And finally, as we discussed, that $6.0 billion ATM equity program hangs over the stock like a dark cloud, threatening to aggressively dilute per share value even if the company hits its operational goals.
So, returning to the core tension we started with, will the market actually reprice this pivot before IREN reaches that 2.5 gigawatts scale? Let's recap the three main takeaways. First, the structural shift is real. They are moving from cyclical crypto to fixed-rate AI infrastructure. Second, the market is currently punishing the stock for the messy, cash-burning reality of tearing down that old Bitcoin mining operation. And third, the massive dilution risk is actively fighting against the massive contract rewards. The one thing to watch next is whether management can rein in that equity dilution while navigating the construction risks. Because if they can deliver on these $13 billion worth of Microsoft and NVIDIA contracts, the underlying cash flow profile shifts to something that looks far more like a premium, highly predictable cloud infrastructure monopoly.
That is the ultimate question here. Are you willing to stomach the ugly, cash-burning reality of today to own the structural, monopolistic data leadership of tomorrow? If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.